Let me be brutally honest with you right now, because nobody else in your life has the guts to say this to your face. The paycheck system was never designed to make you wealthy. It was designed to make you manageable. It was designed to keep you showing up, compliant, grateful, and broke. Just productive enough to not quit, but never free enough to stop needing the job. And right now, somewhere in America, there is a 47-year-old sitting in a cubicle collecting a salary they worked 20 years to earn, and they still cannot survive a single missed paycheck. That is not a career. That is a hostage situation with a dental plan. And I'm going to give you 3 numbers today. Just 3. And if you actually follow them with the discipline of someone who is serious about their financial life, you will build a system where money works for you around the clock every day, whether you show up to that job or not. Pay attention. Before I go any further, I need you to do one thing right now. Hit subscribe. And I'm not asking you nicely. I'm telling you, because what I'm about to break down for you is the kind of financial framework that consultants and wealth managers charge thousands of dollars per hour to explain to their clients. You're getting it here for free right now, and all it costs you is a click. If you walk away from this video without subscribing and something in this video changes your financial life, that is entirely your fault. Subscribe now. Let's get into it. Here is the lie you have been told since you were old enough to sit in the classroom. They told you to study hard, get good grades, go to college, get a degree, find a stable job with a good salary. And that is how you build a life. And maybe your parents told you this. Maybe your guidance counselor told you this. Maybe every authority figure in your entire upbringing reinforced this exact message because they genuinely believed it. But here's what they did not tell you, because most of them did not know it themselves. A paycheck is a ceiling, not a ladder. When you work for a paycheck, then you are selling your time at a fixed rate to someone else who is working for profit. Think about that sentence for a moment, because it contains the entire secret to why your boss drives a better car than you. You do. You are trading hours for dollars at a rate someone else decided you were worth, and that rate has a hard limit. Maybe you get a raise. Maybe you get promoted, but at the end of that chain, there is always a cap and number beyond which they will never pay you, because paying you more means their profits go down. You are not a partner in that business. You are an expense on their income statement. And every single month, when that direct deposit hits your account, that company has already taken their profit out first, and they handed you what was left over after they won. Meanwhile, the average American receives that paycheck and immediately begins spending it. They spend it on a car payment that averages $767 a month, according to recent data, which is a staggering number when you consider that the same person cannot produce $1,000 in an emergency without going into debt. And they are spending money they have not yet earned on a depreciating asset that loses value the moment they drive it off the lot, while simultaneously having zero buffer between their current lifestyle and complete financial collapse. One missed paycheck, one medical bill, one car breakdown, and the entire structure falls apart. That is not wealth. That is the illusion of stability built on a foundation of sand. Here is what actually separates wealthy people from everyone else. And I want you to really internalize this, because it is simple, but it is devastating in its implications. Wealthy people work for profit, not a paycheck. Profit does not stop when you stop working. Profit does not have a ceiling determined by someone else's budget meeting. Profit compounds. Profit pays you while you sleep, while you travel, while you're sick, while you are doing literally anything else. And profit is taxed at a lower rate than earned income in this country, which means not only do wealthy people make more money, but the government takes a smaller percentage of it. The system is not broken. It is working exactly as designed, just not for the people who are showing up every day for a paycheck. You have two choices in this economy. You either own a piece of the profit machine or you're fuel for someone else's. There is no middle ground. There is no comfortable third option where you work a safe job and somehow retire wealthy. The math does not support that fantasy. But here is the good news, and this is the only good news I'm going to give you before I hand you the solution. You do not have to quit your job tomorrow. You do not have to become an entrepreneur. You do not have to have money to start. You just have to follow three numbers. And those numbers are 75, 15, and 10. 75, 15, 10. Write them down. Put them in your phone. Tattoo them on your brain if you have to. Because these three numbers are the mathematical architecture of a wealth-building life. And every single dollar you earn from this moment forward needs to be filtered through them without exception, without negotiation, and without excuses. Here's what the numbers mean. For every single dollar that comes in your possession, 75 cents is the absolute maximum you're permitted to spend on your life. Your rent, your food, your utilities, your car, and your entertainment, your clothes, all of it combined cannot exceed 75 cents of every dollar you earn. That is your spending ceiling. It is not a target. It is a hard limit. The next 15 cents of every dollar goes directly to investing. This is non-negotiable. This is the money that you are using to purchase your financial freedom. This is the money that goes to work when you go to sleep. And the final 10 cents of every dollar goes into savings. Your emergency reserve, your financial shock absorber, the thing that keeps a car repair from becoming a credit card disaster. Now, I already know what you were thinking because I have heard it 1,000 times. You were thinking that you were already living paycheck to paycheck, and there is no possible way you can cut your spending by 25%. And I'm going to give you exactly zero sympathy for that objection. Here is why. If the federal government raised your income taxes by 25% tomorrow, what would you do? You would be furious. You would complain. You might call your congressman, but then you would figure it out because the alternative is prison. You would cut the streaming services you do not watch. You would stop eating out 4 times a week. You would stop buying things on Amazon at midnight that you do not need. You would find the 25%. You always find it when the consequences are serious enough. The difference here is that instead of sending that 25% to Washington, you are sending it to your future self. This is not a tax. This is an investment in the only financial entity that is fully aligned with your interests. You, the 7-5-1-5-10 framework, is not a budget in the conventional sense. It is a filter. It is a decision-making system that removes emotion from your financial choices and replaces it with mathematics. And mathematics does not care about your feelings. Mathematics does not care that you had a bad week and deserve a vacation. Mathematics does not care that your friend just bought a new truck and you want one too. Mathematics operates in absolutes. And when you start operating in absolutes with your money, the results become absolute as well. You either follow the numbers and build wealth, or you ignore them and wonder where all your money went for the rest of your life. Those are the two outcomes. Pick one. Now, here's where most people take the 7-5-1-5-10 framework and immediately destroy its effectiveness because they try to manage all 3 buckets out of a single bank account. That is like trying to run 3 separate businesses out of one checking account and then acting surprised when you cannot track what belongs to whom. It does not work. It has never worked. And if you are currently doing this, you are not following the system. You are performing the system while producing none of its results. You need 3 separate bank accounts. This is not optional. This is not a suggestion. This is the infrastructure of the framework. And without the infrastructure, the framework collapses. Your spending account is where 75 cents of every dollar lives. This is the account you use for rent, groceries, bills, gas, and anything else related to the daily operation of your life. Your investing account is where 15 cents of every dollar goes, immediately and automatically. This account feeds your brokerage, your real estate fund, your index ETFs, whatever vehicle you have chosen to deploy that capital. So your savings account is where 10 cents of every dollar sits and accumulates until it reaches your target emergency reserve. And the word I need you to focus on is automation. You do not manually move this money. You do not trust yourself to make the transfer at the end of the month after you have already spent 3 weeks with access to the full amount. You set up automatic transfers the moment your paycheck hits. Before you see the money, before you're tempted by the money is already allocated. This is not a willpower exercise. Willpower is a finite resource and it will fail you, especially at 11 p.m. when you're on Amazon and something is 40% off. Automation removes willpower from the equation entirely. The system runs whether you are disciplined that day or not. The system does not have bad days. The system does not get emotionally triggered by a sale. The system just executes every single pay period, moving money into its correct position before your spending brain even registers that the paycheck arrived. Your savings account target is between 3 and 12 months of your total living expenses. If you are young, single, with no dependents, 3 to 6 months is sufficient, and you should be more aggressive with your investing allocation once you hit that 4. If you are older, with a family, with financial obligations that extend beyond yourself, you want 6 to 12 months in that reserve because the consequences of a financial disruption are significantly higher when other people depend on your income. Once you hit your savings target, you stop adding to it beyond maintenance, and you redirect that 10 cents into your investing bucket, which now becomes 25 cents of every dollar going directly to wealth building. That is when the system shifts from defensive to offensive. That is when the compounding really starts to accelerate. Now, let's talk about what you actually do with that 15s, soon to be 25s, that is going into your investing account every single pay period. Because this is where the real conversation happens, and this is where most people either get it right or make a catastrophic mistake that costs them years of financial progress. There are 3 primary ways to access profit as someone who is not yet wealthy. And I'm going to rank them in order of accessibility, not in order of potential return, because accessibility is where you need to start. And the first way is to build a business. If you build a business and it generates profit, you own those profits. That is the most direct path to profit ownership that exists. I built businesses. I know what that path looks like. It is also brutal. Most people are not built for it psychologically, operationally, or financially. At the start, the failure rate is high, the hours are extreme, the stress is constant. I'm not telling you not to pursue it if that is what you want. I am telling you that for the majority of people watching this video, starting a business from scratch is not the right first move. It is a future move. Once you understand markets, capital, and risk through your investing experience first. The second way to access profit is to work for a company that gives you ownership in the form of profit sharing, equity, stock options, or company dividends. This is massively underutilized by most workers because they do not negotiate for it and they do not seek it out. When you go to work for a company, especially in tech, finance, or any high-growth sector, the salary is often the least interesting part of the compensation package. The equity, the options, the profit-sharing agreements, That is where real wealth is transferred from companies to employees. Early employees at companies like Amazon, Google, and Meta who received equity compensation did not become millionaires because their salary was high. They became millionaires because they owned a piece of the profit machine. If your current employer does not offer any form of profit participation, that is a legitimate factor in deciding whether that employer deserves your best hours. The third way, and this is the most accessible, most scalable, and most immediately actionable path for the majority of people in this audience, is to use your money to buy access to profits through investing. This is what the stock market fundamentally is. It is not a casino, despite the way most people treat it. It is a marketplace where you can purchase fractional ownership of profit-generating businesses. And in exchange for that ownership, you receive a share of those businesses' profits, either through price appreciation or through direct dividend payments into your account. You are not gambling. You are not speculating. You are buying ownership, and ownership is what generates wealth. Now, within the investing world, you have two approaches that are worth understanding clearly. The first is passive investing, and this is where most people should start and where many people should stay permanently because the evidence strongly supports it over the long term. Passive investing means you are not trying to pick individual winning stocks. You are buying broad exposure to the economy through low-cost index funds and ETFs. A fund like VTI gives you ownership across more than 2,000 companies in the US stock market simultaneously. A fund like SPY gives you ownership in the 500 largest US companies with automatic rebalancing that removes failing companies and replaces them with stronger ones without you having to make a single decision. A fund like QQQ gives you concentrated exposure to the top 100 non-financial companies, which skews heavily toward technology, which means higher volatility in both directions, more upside when markets rise, more downside when they fall. That volatility is only dangerous if you panic. If you hold, it is merely the price of admission for higher long-term returns. If you are interested in cash flow, meaning you want your investments to actually pay you regularly while you hold them, then dividend-focused funds like SAHD are worth understanding. SAHD invest in companies that have demonstrated consistent dividend payments for a minimum of 10 consecutive years, which filters for financial durability and management discipline. You are not just getting yield. You are getting yield from companies with a demonstrated commitment to sharing profits with shareholders across multiple economic cycles. And that is a materially different proposition than chasing the highest current yield from a company that may cut its dividend the moment conditions deteriorate. The second approach is active investing. And this is where you move beyond buying the broad economy and begin identifying specific sectors, trends, or companies where you believe capital is migrating ahead of the mainstream narrative and catching up. This requires research. It requires reading financial statements, understanding macroeconomic indicators, tracking capital flows, and developing a thesis about where the economy is moving before that thesis becomes the consensus. When it becomes the consensus, the opportunity is already passed. The profit from an investment is made at the point of purchase, not the point of sale. You win or lose based on what you paid relative to what the asset is actually worth. Active investing done well, with a genuine information edge and disciplined risk management, can significantly outperform passive strategies. Active investing done poorly, which usually means reacting to news cycles, Reddit threads, and social media hype, then will cost you money with remarkable consistency. Know which category you are actually in before you decide which approach to use. Now, I want to talk about the single most important behavioral principle in all of long-term investing. Because without this principle, everything else I have told you today falls apart the moment the market drops 20% and your friends start panicking and the financial news channels start using the word recession every 30 seconds. The principle is this: always be buying every week, every month, without exception, without modification, based on how the market feels that day. Here's the psychological reality of investing that nobody adequately prepares you for. Markets will go down. They have always gone down. In the last 100 years of US stock market history, there have been more than 25 significant market crashes. That is an average of more than 2 crashes per decade. They are not anomalies. They are not failures of the system. They are features of the system. Predictable, recurring. Events that separate the investors who build generational wealth from the people who buy high, panic, sell low, and then wonder why investing never worked for them. The crash is not the problem. Your reaction to the crash is the problem. When markets decline, most people stop buying. Some people sell. Both of those behaviors are financially catastrophic when you are a long-term investor. Because what a market decline actually represents is a sale on ownership stakes in that profitable businesses. When the S&P 500 drops 20%, you can now buy the same companies you wanted to own last month at 20% less than you would have paid. That is an opportunity. And the investors who recognize that, who have the discipline and the available capital to buy aggressively during downturns because they have been systematically saving and investing all along. Those are the investors who generate the returns that look like magic from the outside. They are not magic. They are math executed with consistency under conditions that cause most people to abandon their strategy entirely. Set your investment to execute automatically on a fixed schedule. Pick a day, it does not matter which day, and set up an automatic purchase of your chosen funds every single week or every 2 weeks or every month. When markets are up, you are buying. When markets are down, you are buying more aggressively using any additional capital available to you, because that is when the discount window is open and the opportunity is greatest. The whole game is participation. You cannot win a game you have left. You cannot benefit from a recovery you sold into the bottom of. Stay in the market, keep buying. Do not let your emotions be the most expensive thing you own. I'm going to end this with a direct challenge, because this is the moment where you decide what category you belong in. You have just been given a complete financial framework. You have the numbers 75, 15, 10. You have the infrastructure, 3 separate bank accounts with automated transfers. You have the investment strategy, passive ownership of broad economic exposure, compounded over time through disciplined and consistent buying, regardless of market conditions. You have everything you need to start building a life where your money earns more than you do. The only variable left is whether you are actually going to do it. Most people watching this video will do nothing. They will feel motivated for about 40 minutes, and then they will go back to spending everything they make, deferring their financial future, and telling themselves they will start next month. Next month never comes. It has never come for them, and it will not come this time either, because starting next month is not a plan. It is a delay dressed up as intention. The people who change their financial trajectory do not start next month. They open a second bank account today. They log into their payroll system today and adjust their direct deposit today. They open the brokerage account today and set up a recurring investment today. Today, not tomorrow, not after the next paycheck, today. I do not need you to be perfect. I need you to start. Because a flawed system that is running beats a perfect system that only exists in your head every single time. Now, go execute.